Thanks, Mustafa. Next up is Edward Kim, and he'll be presenting about reciprocal deposits.
Awesome. Thank you very much to the conference organizers for including our paper in the program. It's a wonderful pleasure to be here. My name is Edward Kim, and this is a kind of relatively new working paper joint with Shohini Kundu, who's actually in the audience today, and Amiyatosh Purnanandam over at the University of Michigan. So this paper provides new insights on deposit insurance, which is arguably one of the most consequential banking regulations of modern times. So what we do in this paper is try to understand how better access or increased access to deposit insurance affects depositors and bank behavior. And as we all know, deposit insurance was developed around the Great Depression to quell investors and depositors' nerves about the stability of the banking system. And this particular topic is front and center for community banks in particular, because these community banks generally are more exposed to very specific localized shocks, and they also do not benefit from the too big to fail guarantees that the largest banks of the system get to enjoy. So this paper addresses the fundamental question where the theoretical literature is a little bit split, and it identifies two main trade-offs between the financial stability role of deposit insurance and potential moral hazard, in that deposit insurance can prevent runs from happening in the first place, but also encourage banks to take on more risk. Unfortunately, it's very difficult to find causal evidence of the relationship between better access to deposit insurance and these depositor and bank outcomes. This is mainly because in the United States and in most other places, deposit insurance provides uniform protections. So any time series or cross-sectional variations in coverage that we observe are inherently going to be correlated with bank and depositor characteristics, as well as local macroeconomic conditions. So what do we do in this paper? We address this fundamental empirical challenge in the context of the 2023 regional banking turmoil. And as we all know, the failure of Silicon Valley Bank was precipitated by three reasons that are relatively well studied: interest rate risk mismanagement, correlation of depositors of the fact that they're very similar, and last but not least, over 90% of SVB's deposits were known to be uninsured. So that's what precipitated this classical depositor run, where the bunch of depositors were running on the bank to get their money back. A less known fact about this particular turmoil is how banks and depositors kind of responded to this increased interest in deposit insurance, as well as increased demand for insurance on deposits that already exist in the system. And what we show here is that regional banks were able to, in some sense, quell the possibility of runs happening to their own banks, and also kind of deflect any issues of potential value being lost for those particular industries. So what we're going to study is this very unique market of financial innovation that we're going to call reciprocal deposits. And let me just talk briefly about how that system works. So under the FDIC's guarantee programs, every depositor's account is insured up to $250,000 at a bank on a per depositor, per bank basis. So if a customer brought $1 million to the bank, only $250,000 of it would be insured. What reciprocal deposits allows banks to do is take that $1 million deposit, break them up into smaller pieces, and find a reciprocal bank on this online platform where they can exchange insurance on an ongoing basis. Right? So what that would effectively do is allow reciprocal deposit participant banks to offer full insurance on very large accounts, amounts that are above the FDIC limits. So what we're going to do today is, first of all, document some very interesting new stylized facts about reciprocal deposits that came into prominence after 2023. And second, we're going to use this market as an empirical laboratory to address some fundamental questions about deposit insurance in the first place. And just as a preview of our results, we do find that depositors do see value in deposit insurance, especially during times of turmoil. Depositors indeed move their funds to banks with better access to insurance, and they also in turn receive lower interest rates from those particular institutions. We see some early evidence of moral hazard in the sense that banks that are exposed or are able to offer higher insurance take on more interest rate risk. And these are some early results that we're going to highlight. And last but not least, we're going to be one of the first papers to provide some insights into how competition in local markets can be affected by how much insurance a bank can provide to their customers. So let's talk about some very simple new facts. Right? Reciprocal deposits came into existence around the early 2000s. They were a very small fraction of total deposits in the United States until in 2018, where Congress passed an act to remove some of the regulatory burdens on banks throughout the system, and the FDIC exempted reciprocal deposits from being classified as broker deposits. And as we all know, that's a fairly large cost on the part of the community banks and other types of banks in the system. So you see the reciprocal deposits growing steadily after 2018, the passage of this act. The interesting part is SVB's failure. So the first set of bars are documenting the 2 quarters after SVB failed. A lot of banks started flocking to this facility to basically insure more of their deposits so that their depositors will not feel the need to run on them. Interestingly, while the level of reciprocal deposits grew significantly during this period, the number of banks participating on this network did not grow as rapidly. And we're going to argue that this is mainly because it takes quite a bit of time and effort for each bank to sign on to the reciprocal deposits network. And as I noted, this is mainly a fintech intermediary, so you have to go through a lot of back-end coordinations, know your customer verifications, all sorts of disclosures you need to sign to be able to get on the network. So after SVB's failure, we see a tick up in the number of banks that participate, but not enough to explain the massive growth in reciprocal deposits over time. So who are participating in these markets? And this is where a lot of interesting facts do emerge. We see that the banks that ramp up reciprocal deposit exposures after SVB's failure are mid-sized and small banks. And small banks are defined as banks with under $10 billion in total assets. So a lot of the community banks that we're talking about this afternoon are going to be in that group. And as you see, there's a very discontinuous jump in reciprocal deposits take up among the smaller banks that don't have this too big to fail guarantee. In fact, most of the largest banks in the United States do not participate in the reciprocal deposits network altogether. Network banks are disseminated throughout the United States. It's not the case that we see some highly kind of localized participation. We see that overall, a lot of banks of different sizes are dispersed throughout the United States who are on this particular market. Another interesting fact is that the main clients that ask for reciprocal deposits are the ones that tend to have larger accounts. So these can be small and mid-sized businesses, public entities, and we're going to talk about them in the second part of our talk today, but also nonprofits as well. So those 3 entities combined account for about 90% of what the kind of providers say comprise the bulk of their reciprocal deposits portfolios. All right, so as I noted at the very beginning, the main challenge of trying to understand the role of insurance coverage on these bank and depositor outcomes is the uniformity of deposit insurance. And how we're going to get around that as researchers is to understand the variation at play, which is banks' presence on the reciprocal deposit network the quarter before SVB failed. So this is 2022 December. We're going to identify a set of banks that are participating in this reciprocal deposits arrangements. And then we're going to compare those banks' outcomes to banks that were not on the network before SVB failed. 2 sets of assumptions need to be held in order for our results to make any sense. The first is that non-network banks in 2022 Q4 couldn't join at the onset of the banking crisis in 2023. So this goes back to the idea that industry professionals have told us that it takes anywhere between 6 to 9 months, sometimes even longer, for banks of different sizes to join the reciprocal deposits network. So banks that were already on had this benefit of being able to tell their customers that, hey, we have this extra facility. If you're concerned about our deposits, we can offer you better insurance at reasonable rates. The second assumption is that network banks have access to enhanced deposit insurance, and we can test that empirically as well. Okay, so for the first assumption, we show that the growth of reciprocal deposits, you see on the right-hand side figure there, is concentrated among network banks. Those are the bars in blue, right? And on the left-hand side, you see that non-network banks, the bars in orange, do not go up as quickly as you would expect, right? If this were as easy as being able to turn on a system and tell all your depositors that you can offer enhanced insurance, it's not necessarily the case because only about 15% of banks join by the end of 2023. The second assumption here is that reciprocal deposits would directly transfer to insured deposits. And we see that trend very starkly here. The bulk of the insured deposit growth that came after SVB's failure actually were a function of whether a bank was on the reciprocal deposit network or not, right? So there are clear limitations as far as how far you can take insurance if the FDIC's limits are capped at $250,000. So a little bit of regression analysis. We kind of have a very simple OLS model where we fix network status in 2022 Q4 and try to use that to predict depositor outcomes throughout the crisis. We see that insured deposits indeed grow at network banks over those 4 quarters. It is not the case that that's a simple transformation between uninsured to insured deposits. We see that depositors actually moving their money from non-network banks to network banks during this period. Right, so this is actual flow of funds from one institution to another based on how much insurance coverage you can offer. And third, we see that banks that are on the network start offering lower deposit rates on those newly insured accounts. So it does seem to be the case that banks are, in one sense, constrained in their ability to ramp up their deposits, especially during this time of turmoil, but also the fact that the depositors are willing to accept a slightly lower interest rate in exchange for higher insurance access, right? So again, the corollary is SVB here with 90% uninsured deposits. The average uninsured deposit ratio throughout the banking system is pushing 50%. So this is a very important implication for banks, but also regulators as a whole. So this is the result on moral hazard. We want to put a caveat here. These are still very early results, but we find that with the newfound flow of deposits, these banks that are on the network are increasing their interest rate risk. And we measure interest rate risk through three different outcomes: the value of their securities portfolios, the average maturity of their securities portfolios, and the probability that the maturity gap between assets and liabilities on a short-term basis are going to increase. For all 3 measures, we see a slight uptick in those measures. So these are the bulk of our results so far. And just for good measure, as researchers, we look further into trying to find a causal link between enhanced access to deposit insurance and the outcome measures of choice. So we do control for observable measures of bank characteristics in our main specifications, but there are a possibility of unobserved differences between these network and non-network banks that might be driving our results at the same time. So one possibility that maybe network banks just have a stickier depositor base. We're able to largely rule that out because not only are banks able to retain deposits, they are getting new flows of deposits coming from other banks that are not on the network. Second, more importantly, is the possibility that these network banks are inherently safer than non-network banks. And we have to address that directly because it is possible that there are some unobserved variations that we cannot see in the control variables. So we test this insurance access channel relative to the bank risk channel using a triple differences specification with the idea that if you are actually a riskier bank or a safer bank in the case of network banks, then your insured deposits should go down, right? Because, then your insured deposit growth should fall relative to uninsured deposits. And we actually find the opposite result. So what we're seeing here is that network banks are increasing, in a relative sense, their insured deposits compared to uninsured deposits. So this goes in support of our hypothesis that this overall growth in deposits and insured deposits comes from better access to deposit insurance and not necessarily reflecting some underlying risk characteristics of those particular banks. We also test using a regulatory change this alternative possibility. So we focus on public entities here because these entities were the ones that were mostly affected by the broker deposits exemptions in 2018. So the FDIC came out with this rule telling banks that reciprocal deposits up to a certain cap will not be considered broker deposits. So what it effectively did was it allowed banks with some level of public entity deposits in their portfolios to switch around this ruling from being a non-network bank to a network bank. So we identify a set of banks that got on the network around 2018 to say that these banks joined the network not because of other kind of competitive reasons, but for regulatory relaxation constraints, right? So we kind of use that as our separate kind of control group. What we do is a simple difference in difference regression. I'm only going to show some figures, but you see that the same results hold. Total deposits grow, deposits rates fall, and interest rate risk tends to go up for these switcher banks that became network banks around the 2018 deregulation phase. And I don't have too much time for this. I'm just going to wrap up really quickly. So we have some interesting new results on the potential competitive market of reciprocal deposits. We show some early findings that network banks indeed grow in the local areas relative to non-network banks after SVB. All right, so to wrap up, we provide some comprehensive analysis of this new market. We kind of contribute to this theoretical literature on the effect of deposit insurance, and we really look forward to hearing the comments from bankers and regulators alike on how they think about this new market as a whole. Thank you very much.